Well, good morning. It's been a busy week, to say the least, of course, dominated by that Federal Reserve meeting. And for today's live event, I thought I'd go and focus on one of the byproducts from the Fed meeting, which is the US two-year note yield. Now, I think it's an unappreciated amount of information in this particular market instrument. So I thought I'd go and look at how the Fed pricing has gone and shifted US two-year yields, and then some of the things that may go and influence it moving forward, because right now, clearly, markets are all on board the soft landing narrative, but there are some things, particularly from a technical perspective, and some big market events coming up over the next fortnight that could really go and change that momentum. So without further ado, let's get straight into it. And I have a quick look at Fed funds futures curve and what's being priced in by traders right now. You can see here on your screen, left pane. This is pricing for the Fed's early November meeting. 27.5 basis points, pretty much in line with what Jay Powell was signaling at his press conference, of course, earlier week, and of course what the dot plots were going to signal when it came to the magnitude of easing over the remainder of this year. When it comes to what is over the remainder of the year being priced, around about 51 basis points, and that's come off levels around about 58. So there was a belief around about the early stages of that Fed press conference and the decision that potentially could be back-to-back 50s coming through. Right now, markets are on board 225s or either just a straight out 50 in November or December. So again, roughly in line with what was being signaled in the press conference, but still more than what the Fed dot plots were entailing. But where the really interesting piece of information is right now is in the shape of the curve from the October Fed funds futures contract out to the December 2025 contract. So basically the amount of easing which is now priced in over the remainder of this year and next. And you can see here that's on the right hand pane, and 197.5 basis points. So nearly 200 basis points of cuts are still being priced. And you can see relative to where that was earlier this week, that's around about 25 basis points less than what was being priced in. Still a lot more than what the Fed is signaling in its dot plots. Remembering the Fed had 200 basis points of easing priced in for, or signal in the dot plots by the end of next year. So even with a 50 basis point cut that's come through, markets are still, give or take, around about 50 basis points more priced than what the Fed has. But that clearly has been curtailed a little bit. And that has had an influence on the US two-year yield, which of course is a little bit further out the US curve. And you can see that here on your screen. This is the US two-year yield. And if you imagine, as expectations for Fed rate cuts started to go and build, and then potentially big rate cuts coming through, you can see it's been quite a big ride. And this was the big plunge that we saw at the start of August. That was, of course, sparked by concern of that carry trade unwind, a very, very weak non-farm payroll support that came through that really spooked the market. Well, we're actually through that level quite convincingly now. But you can see here, relative to where we were before the Fed meeting, right now we're only a few basis points higher, but we have seen that the market, despite the Fed going 50 in September, which was even a bit larger than what markets had priced and certainly more than what most forecasters were expecting for, we have seen US two-year yields actually go and push up ever so marginally at this point in time. Now, I can't go and emphasize as much that the signal that this particular instrument gives you about how the broader market see the US economy, and as a byproduct, a lot of the global economic outlook as well. A lot of information is contained in this particular read. And for the soft landing narrative, I'll start to go and get a little bit concerned if we used to see another big steep leg lower going through here, because that would imply that the Fed has to go and speed up the pace of rate cuts. And it also implies that, of course, that to go and do that, it probably suggests that the US labor market is keeling over pretty badly. So right now, keep a close eye on those levels, because particularly when you look at what's going on when it comes to US Treasury note futures right now. And I'll go and just pull up another chart here. So this is one of the most liquid market contracts you can possibly find. And it's a great source of information. And a bonus is that you don't need to know a lot about fundamentals. From a technical perspective, it is very, very compliant as well on a lot of occasions. You can see here, I don't think it's by chance that we're seeing US two-year Treasury note yields just magically going up in this particular pattern. It's respecting this trend line quite dramatically here. And you can see here that we sit at a pretty interesting juncture, because going back to the course of 2022, you can see did a bit of work either side of that, and then approached that. And this was back during the regional bank crisis that we saw in the early parts of last year. Didn't quite manage to go and break through that. Markets became more obsessed with what was going on with inflation. Outlook went down. And look where we're sitting right now. So we're testing that level right at this point in time. Now, when I was talking about seeing another leg lower in yields and the concern that might go and bring, to me, if we were to go and see this price go and break up into here and then go and test the highs that we saw back in the second quarter of 2022, 105.44 from 104.05 where it is right now, that implies the Fed is having to go and get pretty aggressive out there. So that's not a good sign. If you want to go and continue to go and back the soft landing narrative, to me, I'd rather go and see yields go and stabilize around stabilize around this kind of level here. Any big uplift and breakout that we would see here implies that yields are going sharply lower, and we know that's not really a good sign. Just to go and reinforce that the markets think what the Fed is doing right now is going to go and manufacture the soft landing narrative and help to go and prevent a big uplift in the unemployment rate. I thought I'd go and have a quick look at what is the signals that are coming through when it comes to inflation, market inflation indicators. So let's have a look at five-year forward. So for those who are not familiar with this particular pattern, this market mechanism, let's go and get it up here. This looks at what the markets expect the average inflation rate to be 5 years from now over the next 5 years. Hopefully that makes sense. Anyway, we know that the Fed's inflation target is 2%. And for a long period of time, it was sitting around those particular areas. Now, just recently, it's not the best chart to go and demonstrate this, but you can see here that we've seen inflation expectations 5 years forward over the next 5 years pick up a little bit, 2.13%. Again, this is one of those market measures. You can go to the Fred system there, the St. Louis Fred system, and you can go and look at all this information as well. But if you were to go and see longer term inflation expectations start to go and droop lower, that's not a good sign as well, because right now the markets are saying, well, this is a bit inflationary what the Fed is doing, and that's what the markets are responding with right now. You can also see that as well in US 10-year break-evens, which are basically a market measure. Excuse me, this big, I might go and zoom in a little bit here to go and get rid of that. So you can see here, a good demonstration. Oh, it was. I'll go back to, say, over the next. So basically looking here, heading into the Fed meeting, we could see that markets were about, had the 10-year average rate over the next year for break-evens, bang on the Fed target. But then what we've seen since the Fed meeting's taken place, we saw that the leaks came out signaling that there's a likelihood that we might go and see a 50 come through. And you can see again that the markets have gone and pushed inflation expectations out over the next decade, the average rate to 2.15%. So partly there might be some people getting concerned that the Fed's going to go and create a policy misstep here and spark a big inflationary pulse. I'm not on that boat, but certainly what the signals are telling me right now from this particular indicator is that markets think that what the Fed is doing is helping to go and manufacture a soft landing. So one way or another, despite what you read on social media, including for some of the things that I've put up there over the past couple of days, the markets are giving a little round of applause to the Fed for what they've done, at least so far. Now, the next question is what exactly is going to go and take place when the key risk events that could go and determine what happens with 2-year yields, what happens with 2-year note futures, break-evens and the like, and you've got to go back to what's coming up on the economic calendar. And I don't want to discount the importance of other events around the world, but if you want to go and have a framework to go and build trades around and investment ideas, you've got to look at what the path of interest rate expectations are in the United States and the key events that could go and influence that, because as we've seen in so many other parts of the world, what happens in the US is going to be quite influential in other areas as well. So this is looking at the calendar next week, and as opposed to what we saw this week, the event risk is pretty low, and we know that the Fed is putting an incredible amount of weight on any incoming data when it comes to the labour market. So all the times you can see on the screen here are for us here in Australia, where I'm based, and please adjust this when it comes to your thing, depending on which time zone that you're in. But you can see here, there's not a lot. We've got some Fed speaks coming up, so to go and get the views of what the Fed members are talking about right now. But us, like them, don't really have a whole lot of new information to go on. Of course, we saw some data out last night that was pretty good. When you go and look at some of the key events that could potentially go and create a bit of volatility, the services PMI, the employment sub-index, it's noisy. It could go and move markets because it's one of the few labour market indicators that we're going to go and receive this week, albeit a soft one out there. So that's going to come through on Monday evening, our time, Monday in the States. We're also going to have information coming out later in the week. House prices, I'm not particularly concerned about anything to do with that. The consumer confidence read from the conference board has the labour market differentiator, which basically will go and measure people's views about how the labour market is faring. Again, it's a soft indicator. It's not a hard data, but that will go and get some attention because it's going to go and give the views of Americans and what they're saying about the labour market and the prospects for getting a job and the like. So to me, that's another one to go and keep a close eye on. There are some note auctions out as well, treasury auctions to go and keep an eye on. Given we've seen such a pronounced fall in yields, we know that we're keeping a close eye on the signals from the front end of the curve. When you go further out during the week, again, there's not a lot. We get the final read of the Q2 GDP figures in the United States. We get durable goods orders. Again, that's final reading, so it's not going to go and probably provide a lot of shock factor. Jobless claims, realistically, is probably going to be the biggest data piece of the week. And that's pretty crazy considering it's a weekly indicator, which is pretty volatile. But as we saw that came out, I'm not sure those who've caught up with the news, jobless claims in the States last night fell to dramatically low levels. In fact, the reading that came out, 219,000, was below every single economic forecaster. It's not been a good week for forecasting in the United States, clearly at this point in time. And the 4-week moving average, which smooths out some of the volatility week to week, is sitting at the lowest level in 3 months. So that's really important. It's a good sign for the labour market. It's a good sign for the Fed, and it's believed that it can go and manufacture a soft landing. And importantly, last night, the data that came out was the reference week for the payrolls report. So who knows? It could go and present a stronger picture, at least in the payrolls survey, the establishment survey, when it comes out. So keep that in mind as well. So we could go and see potentially an upside surprise there, albeit we know that we're much more interested in what's going on when it comes to the unemployment rate in particular. Towards the Friday, you can see on Thursday as well, Jerome Powell, John Williams, big boppers from the Fed will be speaking. So make sure you keep that in the diary as well. Anything they can go and add any context to. I'm not sure. Jerome Powell was pretty comprehensive during his press conference, but it's interesting to go and see some of the other views. John Williams is very important, New York Fed president, to go and keep an eye on what they have to go and say as well. Lots of other Fed speakers, so keep a close eye on that. But to me, again, the last thing of the week is going to be pretty important as well. We get the PCE report. So not only PCE deflator, which is the Fed's preferred inflation measure, which I'm not expecting is going to be the big market moving event that it used to be in the past. We've got a good read when it comes through from the CPI and the PPI reports in the States. But I'm more interested in the income and the spending side of the equation, because that's going to give us a sense as to the main driving force of the US economy is the consumer. And what's going on with the income, and is the income going to be able to go and continue to go and bolster consumer spending? We saw the retail sales report came out much stronger than expected during the course of this week. Is that going to flow through to broader spending? Well, the signs are looking pretty good right now, even though the savings rate is pretty low, and that will also be contained in this particular event. I don't want to get too far ahead of myself, but just to go and reinforce what we're looking at right now is that the week after next is going to be the one to go and really pay attention to, because we get lots and lots of labour market information coming out. ISM reports, JOLTS, job openings, we get ADP employment, we get challenger layoffs, we get initial jobless claims, and importantly, we get that payrolls report on the Friday. So to me, it could be a very choppy week as markets wait for that event, which of course, what we've done now is the Fed has gone and put us on alert for that particular release. And that means that anything up to that point is going to largely be noise and potentially fadeable material. So keep that in mind as well, unless we see a really clear, concrete evidence that something bad is going on in the US labor market. So let's go and have a look at some of these other markets out there at the moment. And it's clear that as long as this soft landing narrative holds, and as long as the US 2-year yields continue to go and trade around these levels and don't start to go and take another alarming leg lower, it's going to be a pretty good environment for risk assets. For cyclicals, the reflationary environment should be good. So I thought I'd go and have a quick look at some of the markets out there at the moment. I might go and kick off with Russell Futures. US small caps, very, very reliant on borrowing costs, very susceptible to changes in borrowing costs. and of course in risk appetite as well. And you can see here from a technical perspective, just beautiful breakout, downtrend. I think it's the longest winning streak that we've seen for Russell futures in many years. I think it's up to 7 consecutive winning streaks at the moment. You can see this bounce off the 200-day moving average on the back of very, very, very strong volumes is a good sign. And I wouldn't be surprised, just given the trends we're seeing when it comes to momentum right now, that we might go and retest the highs around about 2,345 that was struck in July. If the soft landing narrative is going to go and hold in the near term, Russell is likely to outperform other indices out there. Over a longer term, that's another question, because if the Fed has to go and start cutting rates because the economy is keeling over, the Russell is going to be one of those ones that potentially is going to fall in a heap. Let's have a look at the ASX, our local market here, and that's been defying all the bears out there at the moment. And if you look from a fundamental perspective at the Australian market, you go, it's very expensive. The banks in particular are extremely expensive from historical and global standards. Why should it be up here? Well, for a start, I think a lot of foreign investors who are using the currency as a potential proxy as well, they're trying to go and get pick up not only from the cyclical side of the equation, but also the currency side. The currency pickup as well will be helping when it comes to those foreign investors, as long as they're unhedged. And you can see here, it just keeps bouncing up, record highs, and you can see here, higher highs, higher lows, should I say, higher lows, and it just keeps the pattern going on. So on the downside right now, if we were to see a pullback, 8137 is the level that I'd be looking for. You can also take note of this uptrend. It's been now respected 3 times. That to me is enough to go and make it something of significance. So keep a close eye on that. Today, we'll see what happens. Nothing in the price signals on the other charts that really suggests there's going to be an imminent pullback or anything like that. So at the moment, the path of least resistance looks higher. Nikkei is another one that you'd expect to go and perform pretty well in an environment where you have optimism about the global economic outlook. Lots of big exporters, of course, and we also have the impact of the yen. And it's had a pretty significant move. I went and flagged this in a post earlier this week about the potential for a breakout. I actually thought that given the calling and the pattern that had come through, that potentially it was more likely to go and break to the downside than the upside. But of course, the Japanese yen has come a little bit weaker. We've seen that uplift in yields come through in the United States ever so slightly, which has helped to go and spark a bit of a short covering rally in dollar yen. And look at where it sits right now. So not only is it broken out of this triangle, it's gone and broken back through this long running uptrend as well, which is important. And it's now taking aim at the 200-day move, or the 50-day moving average, I should say. Now, over time, it does respect it, this particular index and the futures market. But realistically, to me, the more important level is the 200-day just above. So for the bullish side of the equation, you can see from an RSI 14 broken the downtrend. We see MACD has confirmed that bullish signal as well. To me, if we can go and break above this 200-day moving average, you can get really bullish about the Nikkei. And that again would be a sign that the soft landing is in play. It's also very, very similar when it comes to the currency markets as well. And one thing I wanted to go and look at very quickly is what's going on in the Chinese currency, dollar, Chinese yuan out there at this point in time, because it's really, really important from particularly EM and Asia FX perspective, what happens with this particular market, because it's becoming more readily tradable and it's really deemed a proxy for EM out there at the moment. And we had a really interesting move yesterday. You can see here that I'm just taking some chart pieces apart. You can see here that ever so briefly, the price went and broke. And look where it broke through this, back to the levels that we last saw in the middle of, I think it was May 2023 last year. Now, it went and closed back above that. It didn't manage to hold on to it, but keep a close eye on this particular indicator, because if we see dollar yuan break convincingly through there and maybe close beneath this level now, there is not a lot to go and hang your hat on at the moment when it comes to support levels beneath. Let's go and have a quick look. Going back, you can see here, the price has done some work at 7.01265, but realistically, there's almost nothing in between there. And if you talk about, if we see that break lower, I think it's a really safe bet that it's likely the fact that we'll see more developed market Asian currencies, Aussie, Kiwi, and particularly the Japanese yen as well, potentially could strengthen as well. So keep a close eye on that today and over the next little bit. Let's have a look at the Aussie, because it's had a pretty decent run of late. And you can see here ever so briefly last night, it went and actually broke to the highest level since the early parts of January. And it got back, knocked back lower, which is interesting. But you can see from a technical perspective, from a momentum perspective, MACD and RSI 14 are both looking pretty punchy at this point in time. They're both generating bullish signals. But the thing I want to go and just zoom out a little bit is to go and look at the Aussie on a weekly time frame. Much clearer signal coming through. And you can see here, it's a pretty important level where the Aussie stalled at last night, because you can see here, long running downtrend. This is going back to the early parts of 2023. Rejected, didn't even think about it, and then rejected again. So to me, you want to go and see the Aussie break this particular level. And then if that is the way, you can see there's a couple of minor levels up here, and then around about 69. If you're an Aussie bull and it starts to go move higher, that's the level you've got to focus on, because we have the intersection of horizontal resistance and long running downtrend resistance as well. And that's going back to the highs that were struck in the early stages of the pandemic, early 2021 from memory. So at the moment, the Aussie looks like it wants to go high. The environment suggests that it's going to be one that will be beneficial for the Aussie. And you can see here, particularly later on next week, when we start hearing the RBA and we get some inflation data out as well, that could potentially be influential of that. And I'll cover that towards the end. Let's have a quick look at what's going on with Japanese yen very quickly as well. We'll go back to a daily time frame here. So you can see here on the daily chart, this little hammer here, that to me was one of those clues that potentially we had bottomed. I went and put out a bullish call, and after a bit of choppiness, it came to fruition, thankfully. And you can see here, broke this minor downtrend and then stalled here at 143.63 and reversed back. So it's not been a convincing breakout at this point in time, but from a RSI 14, from a momentum perspective, they're giving mildly bullish signals to me. So realistically, at least it's stabilized. And that's a good thing when it comes to carry trades and everything else. And for riskier asset classes, that's going to be something to go and keep a close eye on. If we start to go and see dollar yen going leg lower again, that's going to be an environment that could go and put some risk assets under pressure. Right now, though, it looks it's a bit rangy at this point in time. So that will be my favorite play at the moment. Unless we see a really big uplift in yields or really big decrease in US yields, particularly at the front end of the curve, US 2 years and the like, that could be the modus operandi that might work best from them. All right, I know we're running short on time, so let's have a quick look at some of actually, we'll go back and have a quick look at what's going on with gold, because we know that's getting a lot of attention, hit record highs, and then backed off pretty aggressively, it's got to be said. But when you look at the longer term picture here, it's undeniably bullish. You can see here, it's doing a lot of work, 2560.17, fell through there, bounced up again. Got to adjust this actually. You can see here, got to the record 2,600 and it's stalled, but when you look at what's going on with momentum indicators, they're all bullish at this point. So for me, it's buy on dips and it's just going to keep grinding higher. I would pay attention to these uptrends that you can see, and you can go put them on your own charts and just keep a close eye on that. If we start to go and see momentum indicators roll over, we see the price start to go and break through those levels, potentially the bias would go and shift around from being bullish to bearish. But gold looks pretty good right now. Silver has more industrial characteristics and is more of a cyclical play when it comes to the other economy. So you can see here, it too has had a decent run of late. Although you can see here, the price action has been very choppy after breaking out a symmetrical triangle. There's been no real gusto to go and break higher and potentially go and take out these minor resistance levels that we can see that were set earlier in the year. But no, good battle underway. You can see the wicks, particularly on the top side. People are prepared to go and sell at this point in time, but at the same time, when the price goes back to this former downtrend, it's bouncing off it. So that are the levels to go and keep an eye on right now. Momentum indicators are looking pretty good here and now. Let's have a look at iron ore, because I know that some people out there like to go and keep a track of Australia's, I think, former most valuable export right now. So have a look at SGX iron ore, because very quickly overnight we got a decent bullish signal coming through. Volumes have been okay as well. You can see here. So this reversal just stopped short futures from being a key reversal, but a bullish engulfing candle, and we've gone and moved back into the to the flag pattern that was in operation for a couple of weeks. But to me, the big volumes, the reversal from a known support level that runs back to many years ago, and then followed on by today, suggests that we might go and see another push higher back towards this long-running downtrend and the key 50-day moving average. So iron ore is looking good right now. Just to go and finish off, looking ahead, so a couple of events that I know markets are probably focused on right now. The BOJ meeting later on today. Now, markets, traders, investors, whatever you want to go and call us, we're all a bit twitchy, it seems, about anything that comes out about the BOJ signaling that they're prepared to go and hike rates again, because we know the ramifications. You're going to increase the cost of borrow when it comes to those carry trades. It can go and place pressure not only on the carry cost, but also what could do with the currency valuation and maybe go and translate it back into Japanese yen. The one thing I just want to go point out is that markets have already got more easing priced in for the BOJ. So just by the fact that the BOJ are talking about hiking rates again, which potentially we could go and see again today with the latest press conference after the decision drops, whenever that's going to be, don't be surprised, because it's known. We have around about, when I last looked, about 20 or so basis points of hikes still priced over the remainder of the next 12 months. So that's something to keep in mind when you go and see the markets get the heebie-jeebies about the yen potentially strengthening, the BOJ getting hawkish and the like. It has been priced. Unless there's something that's really cataclysmically changes that narrative, yeah, I'd be inclined to go and fade any moves. But don't be so urgent to go and do it straight away, because it can go and take a while for the markets to go and flush out these concerns. The other thing next week is that the RBA. Now, I know people are looking at what the Fed's done, 50 basis points, and said, well, the RBA is likely to go and follow suit. Yeah, eventually. I'm still skeptical. At this point in time, markets are still marginally favouring that the RBA will go and cut rates by 25 basis points by December. It's really difficult without having to see a really, really big rolling over of the labour market, and we didn't see that in the labour force survey yesterday, or the full gambit of the CPI basket. Now, we get the second month of the quarter CPI inflation indicator out next Wednesday. It's going to get a lot of attention. It will have a little bit more information about services components, which are more domestic orientated and are likely to go and be more influential on the RBA's decision, but it's still not the full gambit. And you just have to look back to what was coming out of these monthly indicators in the prior quarter to go and see that the information contained in them was not helpful in the slightest when we got the quarterly reading, which was very much of a different story. Really snuffed out the prospect that we might go and see the RBA hike rates again. When it comes to the headline figure, we know it's going to go and show that it is now back in the RBA's target band to 3%, I should say, because that's where we're going to see the mechanical effect of those electricity subsidies come through. The RBA, even though their mandate just doesn't specify what inflation reading, they've been on the public record on multiple times to say that they're more concerned in the underlying pace of inflation. So to me, trimmed mean reading is the one you should be focusing on when it comes to next Wednesdays. And just be careful putting too much weight on it, because it could potentially go and be a very, very different signal that the quarterly report provides 1 month later. As for the RBA decision that will drop on Tuesday, realistically, I think that we've got to go and suspect that it's going to be much the same. Not ruling anything in or out, and will not hesitate to go and hike rates if it's necessary. I can't see the RBA, even with the prospect of that inflation indicator coming back into the range temporarily due to government subsidies, really changing the tune right now. So the things that are going to go and potentially really go and influence the RBA to go and cut earlier than maybe early next year, which is where I favour at this point in time, would have to be the Q3 inflation report that comes out in November. In late October. That is the one to go and keep a really, really close eye on. That will set the tone for the RBA. And one thing that Michelle Bullock went and said when she was talking at a speech a couple of weeks ago was that they not going to put too much weight on any one inflation indicator, one report. And to me, I don't think they're going to go and mention the monthly indicator there. I think they're talking about quarterly reports, which to me says that if there's going to be a move and they're going to have confidence that the inflation is going to come back to target in a timely manner, then they probably have to go and see 2 quarterly reports, which means that would be coming out in late January, which will put the February meeting on the radar. With that, look, I might go and open the floor up to any questions very quickly. I know that a lot of people have been very patient here. I'm just going to put up the disclaimer just to go and remind you that anyone who wants to participate in the Q&A section is doing it at their own free will. I'm doing this in a general advice nature only. I'm not paying attention to any of your personal circumstances and the views being presented are solely mine and not of City Index Australia. I'll leave that up on your screen for the moment. Give you some time to go and think about it. If you've got any questions, shoot them through. Otherwise, we'll go and wrap up. I'll give you about 30 seconds to a minute, and then we'll go from there. I think everyone's knackered after what's been a really long week. Thank you so much for joining me today. Have a great weekend. And for those who are watching the football this weekend, hope your team goes well. And from my perspective, go the Swans. See you next time.